Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I author in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player.
Good day, all. Ira Epstein of Linn Associates with your financial market wrap-up for this Tuesday, the 4th of December, 2018. I'm at 3:25 p.m. Central Standard Time, which means in 5 minutes the markets will reopen and they'll trade until 4 p.m. But you're looking at the settlement prices in all of the stock indices because that's determined on futures at 3:15 p.m. Also remember that the markets are going to close first thing in the morning, I think 8:30 a.m., and then be closed the rest of the day in remembrance and part of the ceremony of George H.W. Bush's funeral. So, got all these things happening. Was today one of these funny days in front of a market that has an abbreviated week? Don't know. What I do know is the market is questioning if President Trump didn't oversell what actually took place between he and President Xi of China. And that becomes a big issue for the market. You're also getting inverted yield curves in the 2 and the 5-year note. That's where the 2-year goes over the 5, and that's not a good thing. And now the market's getting concerned that the 2 and the 10 might invert. Often, when that takes place, it's the prelude to the market going into a recession months up to a year and a half or so later. So these are all bad pieces of news. The gold and the silver were up, while copper, which is what I call the bellwether market, to give you an idea how China's doing, it looks terrible. Down 500 points today. Very poor action. Dollar down a little bit, mixed bag in most of the foreign currencies, and Brexit took another hit today, as now it appears that the European Union is going to take the attitude, at least the court there, that if Brexit were not to happen and the citizens of the UK wanted to back out of it, they have the right to do that. So that's another blow to Miss May. Let's go to the charts. You're still over where the market finished 2017. So we had a nice rally and a pullback. You can also see something else just visually here. If you look at the weekly chart, you've got, right now at least, lower highs, lower lows. Admittedly, the week's not over. So this is where you finished last week, and I can't tell you that it's going to end up like this. But it gives you an idea that if the market can revert and get through these highs, maybe you get a further rally. Problem is, why would you rally unless you get a reason to do so? Larry Kudlow threw out something today to think about. He said it's pretty easy if China wanted to roll back the auto tariffs, and that could be a litmus test. I'm writing about that in my report tonight. Pretty true. I don't see that occurring. When we take a look at what happened, yesterday, if you'll recall, I walked you through and I said, okay, here's your big rally. You're into what I call this top box of Fibonacci. Now, Fibonacci was measured from this high in October to the break low. The bounce back was in the 62% level. You fell back under, and now you started the rally and ended up yesterday right up here again, making its way to that 62% retracement. The key was to close over this number, and then I said, and I'm pretty sure I would have said that, then I can take off this Fibonacci count. Well, guess what? I can't. The market fell back. What else took place? If you look at right here, from the rally high on Friday to the break low on Monday, the low of the day, you had a gap. You filled that gap in today. And one of the things I wrote yesterday was markets generally don't leave gaps. So you filled in the gap here, and you're going to see in most of the indices you did that as well. When we take a look at this break, unless you take out 26.26, this is a pullback in a market that can still end up with the bigger picture on a daily chart of higher lows and higher highs. Do not rule that out. Where you fell back to today was a challenge again, and I'm going to come back here. You got up to challenge close to the 100-day average, and instead the 200 doesn't have much meaning. I'm seeing that as it just shoots through it on the upside and the downside. I would not be surprised tomorrow to see the market make an attempt. Actually, it won't be tomorrow. It's probably going to be on Thursday if the market tries to make a rally back to that 18-day average to fight the battle. Because so often, what I call the line in the sand is where this type of action occurs around. You didn't quite get to the upper Bollinger Band or the 100-day average. You're back to the 18. Should you drop real hard, the lower Bollinger Band ties in with this previous low here in the 26.19 area. When I look at momentum, you've corrected. Past tense, getting overbought. This is how you looked yesterday. Overbought into the resistance zone. Didn't quite hit the price of the 100-day average in the upper Bollinger Band. You did not pay attention today to the 200-day. You can see that, and instead you're falling back. Again, I wouldn't be surprised if last year's closing price offers a little bit of a bounce area. When we come to the NASDAQ, here too you've worked off the overbought condition. Here you did get to the 200-day average and it mattered. It didn't matter as we come to the S&P on this time around, but it has mattered in the past at the NASDAQ. So you pay attention to what's mattered. And here too, the 18-day average, very important. Unlike the S&P, you already have the pattern of higher lows and higher highs. So this break back to the 18, as a market technician, tells me, look for this battle to fight in that general area. As I step to the Dow, it's more similar to the S&P in that it's got a lower low and a higher high. Again, let's step back. The 100-day average of closes mattered on the rally on Friday. You rallied away from that yesterday. Today, it didn't matter at all. It's again the 18-day that's probably mattering in the 200 here. These averages move all over as to what's important, but it doesn't matter to me because I'm not trending. I have that lower low, higher high, but I recognize that with today's break, I'm out of the overbought condition in the market, and the weakest of these remains this market, which is the Russell. In the Russell, this break low took out a previous break low. So we had a small move to the upside that failed miserably. I could argue I got a higher high now and a lower low, momentum pointing down, bias down. This is a market still in trouble, although the bigger picture is pretty much sideways. In a nutshell, none of these stock indices are holding rallies. That's the right thing to say. In the VIX, I think I said yesterday, I wouldn't be surprised, I know I said it this morning to my traders, that if you hit the lower Bollinger Band, that you're going to see put writers come out of this market. Well, my ideal was right. You rallied right back through the 18-day average of closes. I'll now say the opposite. If you get up to the 18-day average high, the call writers will probably step in, trying to see if they can get back to the 18-day average of closes. You seem to be now going sideways, whipping back and forth. Momentum up, bias up, but not a trend. In the T-bond market, this is the run on money. Does it seem like 5-6 weeks ago or so they were talking 3.25%, maybe 3.5%, and we're hearing that it's going to go there? You realize the yield on this market now is around 3%, and in the 10-year, 2.91%. That's quite a bit down from talking where the market was. You have embedded readings which are bullish. Yes, you hit your upside target, the upper Bollinger Band. Yes, you've hit your upside target. But would you think this market was rallying this powerful? This is not what we thought, and this is a sign of a weak economy. You heard what I said, a weak economy. The interest rate market is smart, and it is seeing a problem. TLT follows what that does, and you had yesterday a market that established higher lows, higher highs. The key was to not take out yesterday's low. First resistance would have been the upper Bollinger Band. If that succeeded, then the 100-day average. You got up through both. I don't know where you'll go, but you only stay over that upper Bollinger Band 5% of the time. The important part is everybody underneath these prices, and that's a long time frame through October, is wrong. Every short in that market is wrong. In the dollar index, we're still in the bear camp at this point. we have the lower highs, lower lows from the swing line. It gets negated because you're closing over the 18-day average of closes. If the market gets through 97.24, it might make a run to the upper Bollinger Band. If the market can manage to not take that out and start slipping back, you have in play the lower Bollinger Band. You have in the eurocurrency the flip-flop of this. You got higher lows, higher highs. As a technician in the market, I wanted this market to close over the 18-day average and this under to have trends set in. Now they're in question because of these weak closes today. When we come to the British pound, all you did is rally up to, challenge the zone of the 18-day average, that line in the sand, and collapse in the market. In addition, you've got both numbers under 20 in the slow stochastic today, yesterday, day before. You have what we call embedded readings. Until that reading's lost, I look at this market as going to be sold by the pros, and they'll continue selling until that's lost, in my opinion. Then, where do you run for a safe haven when you don't know what to do? All of a sudden, the Japanese yen is back in favor. Higher lows, higher highs, momentum up, bias up. This market's got a target potential of at least the upper Bollinger Band if it continues to move up, and if it can exceed that, maybe the 100-day average. Support in the market back at the 18-day average of closes. In order to break the uptrend, you'd have to get through 87.94 in the current chart pattern. In Bitcoin, you have the embedded reading, which means this bounce is just that. And that's what I pretty much said in my topic today on TikTok, on Bloomberg. I was saying that I wouldn't be surprised to see this market take another dive yet. Lose the embedded reading down here, I'll change my opinion. Don't lose it. I get more engrossed, if you will, or embedded into it, thinking that maybe a crack at the 3,000 level can be it next. As we go to the crude oil, you can see that you lost a little ground today of WTI to the Brent. In other words, the spreads are narrowing. Remember, we have come Thursday the OPEC meeting in Vienna. That's December 6th. Today, Alberta, Canada's premier said what? 8.7% cut, mandatory, of all oil companies producing there from this year's production to next. She's forcing the cuts. They can't get rid of their oil. They sell it to what, $25, $30 discounts at time to WTI because they're landlocked. They have no way to get it out of there. And the environmentalists, as long as they keep fighting, well, they're just losing all that value. She's going to start production cuts. I guess that helps balance oil. Do you know what size Canada is in the world production scheme? Fourth largest producer. In crude, in looking at this pattern, you have a lower low, higher high. Why not get up to that 18-day average? I still see that as a strong possibility. When you lose the embedded reading, and this is what it looks like, you lost it yesterday, you confirmed it today, price and the 18-day average often make a run right at each other. The same is happening here in the Brent, and I think you'd agree, it just about got there. Missed it by 12 points so far, but I wouldn't be surprised that it hits it. Rebob gasoline on the move for that. I wouldn't be surprised to hit that 18-day average. And in that gas, well, this is a weather market, so the first challenges of the 18-day average, feeling its oats. Now a little colder forecast is coming in. Do we have a trend here? Not really. You got a higher high and lower low. Let me tell you something that we're going to have some fun with tomorrow. Because I didn't know it, but because you're not open in the S&P and the Treasuries tomorrow, I'm going to have a lot more time to answer your question in our live webinar. It takes place at 12:30 p.m. Central Standard Time. Bring your questions, bring the symbols if they're stocks or ETFs, because I won't know them all. And at that, we can bring up the charts, put on our indicators, and have some fun with it all. It's an invitation only, and I have sent out the invite. So check your spam, check your clutter, your junk mail, all the areas if you didn't see it, because if you're on my mailing list, it was sent. If you've been called off the list, well, then just simply give us a call. My staff will send you out that invite. It's 12:30 p.m. Central Standard Time. You need the invite, the password. You get the password after you register, and it is a free webinar. I'm Ira Epstein. You have a good day, and I'll see you all tomorrow.